Hello, everyone. Welcome to Money Hour Radio, a show where we try to help you grow your money, pay less taxes, and have a beautiful retirement. What could be better than that? I am one of your co-hosts, Ben Barzideh. I have my co-host, Matt Nadeau here.
Hey, everybody.
We are both founding partners and wealth managers at Barzideh and Nadeau Wealth Management, a comprehensive financial planning firm located locally here in Barrington and serving the greater Chicagoland area. And we are fiduciaries, and as an independent, family-owned firm, we truly have the freedom to focus solely on your interests, not some corporations.
That's a big thing, not some corporations. That's going to be something we talk about today. But before we get there, just want to say hi to all of our clients who faithfully listen. You know, we appreciate the trust you place in us. And of course, we love every one of you. And we do have a great show. Like I was saying, we're going to talk about how private equity is ruining America. It's a big one. You don't want to miss this. And then after we're done with that, we actually have an incredible segment talking about 6 most effective tax-efficient strategies to give to a charity or your church. You do not want to miss that. But of course, before we get started, I want to just tell everybody, please take a minute, hit that subscribe button on YouTube. Just helps us out. Go to moneyhourradio.com and subscribe today. You can view this week's episode, some of our previous episodes, and we have a great weekly economic newsletter. And we like to call it the 5-minute market brief. And that's an informative, succinct, easy to read newsletter you get once a week. You can sign up on our website at bnwealth.com. And please follow us with all of our social media. Go to BN Wealth social media pages on Facebook, Instagram, and again, subscribe to YouTube. Thanks.
All right. So how private equity is ruining America. And as we start this segment, for legal and compliance reasons, we want to first preface that everything we're going to talk about, we want to put the word allegedly in front of it.
It's like we're lawyers, allegedly.
Kind of like when people say, with all due respect, right before they say something very disrespectful. So again, allegedly, how many times lately have you seen your favorite restaurant, your law group, medical provider, or even your dog groomer get bought out by some big company, and shortly thereafter, everything goes downhill? Or perhaps you worked for a company where you saw that happen firsthand. Well, you can probably thank private equity for that.
Oh my gosh. And these private equity models are deceptively simple. They buy a private, successful company using a bunch of borrowed money, and then they cut costs aggressively and extract profits quickly. And then guess what? They sell the business before all the wheels finally fall off. It's like a parasite sucking the life out of its host's organism. And, you know, it might enrich their investors, but it can devastate workers, consumers, communities, entire industries. Gosh, it's terrible. And in our view, it is changing the fabric of what made America great. All over the country, small family entrepreneurs and enterprises, local mom and pop shops, businesses with a great history and rich culture are getting bought by these multi-billion-dollar companies and just turned into another cog in the wheel.
It's terrible. And what were independent, client-centric businesses are turned into profit-focused chains and conglomerates. What was boutique-y and customized is being replaced by packaged products and one-size-fits-all. And if you're doing business with a company that's owned by private equity, we think it's important for you to understand where your money is going and how it may be affecting your community and beyond. And with better knowledge, you may alter where you spend your money.
Yeah, so it's not just one industry. Private equity is literally buying just about everything they can get their hands on these days, from hospitals, newspapers, financial firms, even some of our favorite sports teams. And with it, they're literally hollowing out America's economy, one leveraged buyout at a time. Now, federal prosecutor Brendan Ballou, I hope I'm saying that right, outlines this in his provocative book, Plunder: Private Equity's Plan to Pillage America. That leveraged buyouts, which is what private equity is, became popular in the 70s and 80s. People like junk bond king Michael Milken took notice and started following the model until things went bust, right? The leveraged buyout industry got a nasty reputation as the quote, robber barons of the 80s. And then the industry decided to go and rebrand itself as private equity. According to Ballou, it's predatory capitalism on steroids.
No doubt. So here are some examples. Local journalism. When private equity firms acquire media outlets, they typically slash editorial staff, outsource operations, and prioritize clickbait over community reporting. And it happened to Deadspin, for example. In healthcare, private equity firms have bought up hospitals, nursing homes, and even veterinary clinics, often prioritizing short-term returns over patient care. In many cases, this means understaffing, cutting corners, and hiking prices. A once thriving neighborhood clinic might suddenly become a profit maximizing enterprise and with fewer nurses and longer wait times. The consequences can actually be fatal. Peststakeholder.org wrote that studies have shown increased mortality rates in private equity owned nursing homes.
And then retail and housing, they've been a huge area for them. So PE firms have acquired your chains that you've seen like Toys R Us and Payless Shoes, and then they load them up with debt and extract dividends before going to bankruptcy. And in housing, they went out and turned family homes, these single family homes, into rental empires, which is driving up prices and squeezing out the middle class. And, Ben, recently I saw a post on LinkedIn, and I'm sorry, I don't remember who, but it read like this. And again, allegedly, I've got to say that private equity bought up 80% of healthcare. And what they do is they buy an organization, strip it of its assets, load it with debt, pay themselves huge fees and bonuses, then sell the shell of a company that is effectively worthless. For instance, some pension fund controlled by people who are not smart enough to recognize they just bought a piece of garbage. And that's why there's a 47% bankruptcy rate after sale.
No doubt. And of course, we can't, again, verify that 47% figure. It was someone's post. But I did do some quick research, and here's some numbers. Peststakeholder.org wrote that private equity accounted for 21% of all healthcare bankruptcies in 2024. The Atlantic in May of 2023 wrote, companies bought by private equity firms are 10 times more likely to go bankrupt than those that aren't. And private equity firms, because they're so over-leveraged, they are much more prone to going bankrupt. And there's tons of information online. If you're looking to research it, you can. And if you're looking to sell your company to private equity, here's what you need to expect. An article by Jim Schlexer summed it up well. It's titled, "The 6 Things a Private Equity Firm Will Do After It Buys Your Business."
All right, I want to tell you the first thing to know is that the PE firm will want to keep you, the founder, after you sell it, at least initially, to lead and continue to grow the business. They'll include earnouts as part of these deals as a way to tie your compensation from the sale to the future continued performance. And then second, guess what? You're eventually fired or maybe quit or forced to quit. So you'll probably bump heads with the new owners about everyday decisions. You'll have your way, they'll have theirs, but now they're your boss. And it usually takes about a year before the noose starts to get really tight around your neck. And then third, they're going to load up your business with debt, typically about 4 to 5 times your profits.
And fourth, they will also kill your company's sacred cow early on. What was important to you may not be to them. Every expense will be on the table for analysis. Fifth, private equity firms will also sweat your assets, especially if there's any cash. they'll begin to aggressively collect any money due while stretching out the terms of your suppliers. If you paid them every 30 days, expect them to get now paid every 45 or 60 days. And then lastly, private equity firms will also pay themselves special distributions with any extra cash that they can generate from your business. That cash can be used to leverage up more companies to buy, and they may add top-of-the-line fees that maximize their revenue while shortchanging the profits you receive on your future payouts.
And without saying why we dislike it so much, we do. And that's why it's important to us to be an independent, family owned business. We live in the communities we serve and earn trust the old fashioned way, one family at a time. We take pride in that. And personally, in my life, I'm trying as much as possible not to spend money with these big private equity companies. I'd rather do business with local firms and shops that are supporting and enriching our community. And also why we bring on other professionals from our community as guests on our show.
This is also why we have the charitable arm of our company called BN Giving. And if our philosophy resonates with you and you want to explore becoming a client, reach out to us online at bnwealth.com or call our office at 847-780-2980. All right, don't go anywhere. We'll be right back.
All right, welcome back. Thank you for tuning in. This is Money Hour Radio, a show where we try and help you grow your money, pay less taxes, and have a beautiful retirement. And I'm one of your hosts, Matt Nadeau. Of course, I've got my co-host, Ben Barzideh.
Hello, everyone.
And we're both founding partners and wealth managers at Barzideh and Nadeau Wealth Management, a comprehensive financial planning firm located here locally in Barrington and serving the greater Chicagoland area. So if you were tuning in before, you know we got a little fiery about these private equity firms and important to be local. Well, we are local here and we are serving our local residents in the Chicagoland area. And we have a simple model. We call it do great work, have fun, and give back. And that's why we created BN Giving. And it's a way for us to invest in your purpose with you.
Here's how it works. If you become one of our clients and you're a faithful tither or a regular giver to a qualified 501c3 charity, just let us know. Each year, we will match your donation up to 10% of the management fee that you pay us. And this is a whole movement that we are pioneering that's unique to our firm, one that celebrates the culture of giving and a more altruistic way of doing business. And by partnering with like-minded clients who share our vision for generosity, we aim to align our values with yours, helping your generosity go even further. And as our firm grows, so does our collective impact. And by the way, if you're not a regular giver, that's okay too. Most people aren't. We'll still be honored to work with you to explore how you can join our BN Giving community by becoming a client. Please reach out to us online at bnwealth.com or call our office at 847-780-2980.
All right. And along those lines, Ben, we have a really good topic we wanted to discuss today because giving is so important to us. And we find that those who give often aren't doing it in the most efficient way. So we're going to talk about the 6 most tax efficient ways to give to a church or a charity. And for faithful tithers committed to supporting their church or donors to a charity, it's important to understand the most tax efficient way, right? That is truly not just a smart thing to do, but it's also a form of stewardship. By leveraging tax savvy strategies, donors can potentially not only reduce their tax liability, but also increase the net impact of the giving and your generosity. So this means more resources for ministry, outreach, community support, without increasing out-of-pocket costs. And when giving is aligned with smart tax planning, it helps your contributions go even further for the causes that you truly care about.
Absolutely. And the first one we want to talk about, so we're going to start the 6 best ways, most tax efficient ways to give to your church. And the first one we want to talk about is something that actually impacts a lot of people. It's kind of the low hanging fruit. So if you're, it's called Qualified charitable distributions from your IRA. And how it works is if you're 70 and a half years old or older, you can make a qualified charitable distribution from your IRA directly to your church or favorite charity. And this allows you to transfer over $100,000 a year, which is indexed for inflation. So that amount goes up. But you can transfer that per year tax free to your charity, and which can also satisfy your required minimum distribution, RMD, without increasing your taxable income or your adjusted gross income.
Yeah, sadly, there's a lot of people who are taking their RMDs, putting it in their bank account, and then going out and giving or tithing and missing out on this opportunity. So it's definitely low hanging fruit, one you should look at. Ben, the next one I want to talk about is what we call donating appreciated non cash assets instead of cash. So if you're thinking about, let's say you're selling some highly appreciated publicly traded security, so your normal stocks, ETFs out there, real estate, or any other non-cash asset, and then you're going to take those proceeds and donate them, you really want to stop and consider gifting the asset directly to the charity instead. So generally, by doing this, you can eliminate the capital gains tax that you're going to otherwise incur from selling the asset as long as you've held them more than a year and claim a charitable deduction for the fair market value of the asset. So you're eliminating the long-term capital gains tax, which is typically, 15 or 20% for most people, depending on your income level. And you can then increase the charitable contribution available to the charities by up to that 20% as well as boost that tax deduction.
That's such a powerful concept. So the next thing you can look at is bunching charitable contributions in one tax year. And if you anticipate your total itemized deductions will be slightly below your standard deduction amount, you can combine or bunch contributions for multiple years into one single tax year. And with this bunching strategy, you would itemize deductions on your current tax return and take the standard deduction on future returns to potentially produce a larger 2-year deduction than you would get by just claiming 2 years of the standard deduction.
Yeah, and let's take that idea and juice it up like on steroids here, which the next one we want to talk about is using a donor advised fund. So you can actually bunch many years of giving into one of these donor advised funds because it allows you to make this large charitable contribution at one point and get an immediate tax deduction. And then what you do is you use that fund to give out your charitable donations over time. And this can be really beneficial if you have a high income year, as it allows you to really reduce your taxable income in one of those years. And a lot of times you see that like right before somebody's going to retire. Maybe it's the last year they're going to be having a bunch of income. So that's a huge benefit. And then what you can do with that donor advised fund is you name a charitable beneficiary of retirement assets, life insurance policies, annuity contracts. You can have that as the beneficiary, and all the remainder beneficiary of a charitable trust as well can go into one of these donor advised funds.
Well, speaking of charitable trusts, so one of the most powerful tools is what's called a charitable remainder trust, sometimes shortened CRT, as people say. But with a charitable remainder trust, you donate assets to a charitable trust while receiving income from that trust for a set number of years, or for instance, for the rest of your life. At the end of the term, the remaining assets will be gifted to the charity of your choice, and you may claim a charitable deduction for the year you fund the trust. And the deduction amount is typically based on the present value of the assets that will eventually go to the named charity in that trust.
Yeah, and you can actually blend that strategy, Ben, like putting appreciated assets that you would generally get capital gains and put them in the charitable remainder trust. You're getting all these benefits if you use it properly. And then number 6 we want to talk about is actually naming a charity as one of your designated beneficiaries. So, unlike individuals who inherit like a taxable retirement account, like an IRA or a 401k, public charities don't have to pay income tax on gifted assets at the time of withdrawal, making it an ideal beneficiary on some of those accounts like the traditional IRA or employer sponsored retirement plans. Every penny of those donations are going to be directed to support your charitable goals beyond your lifetime. And what's more, designating a charitable remainder trust that we talked about earlier as your beneficiary will combine a gift to charity and could also establish income to your heirs at the same time. So it could be super powerful.
That's a very powerful concept as well. And at BN Wealth, Barzideh Nadeau Wealth Management, something we pride ourselves on is we're always looking to collaborate with people and organizations doing good work in our communities and beyond. And if you're part of a church or another charitable organization, and you want to educate and empower your donors with these tax savvy giving concepts, and there's other ones as well, we'd love to connect with you. Our team, we offer complimentary educational options on tax efficient giving strategies and the best way to maximize your donations, empowering both your donors and the nonprofits to maximize their impact. And what's interesting, Matt, is uh, it, these are things that if you're a pastor of a church or if you're one of the elders, these concepts are such that things that you need to speak to your congregation about. And for someone like myself, my wife and I, we go to church. We've been going to church for many years. We go to a big popular church in our community. And I don't remember ever really hearing anything about this. So this is something that's very valuable. And if you are looking for people that can talk to your congregation about this, we'd love to be able to help out.
Yeah, and definitely we'd be happy to talk to you directly, talk about some of these strategies. It, it directly benefits your donors, your congregation. It also benefits your charity or your church because you're getting more money without it even costing your congregation anymore. So these are important strategies that just don't get talked about a lot. And it's like school doesn't teach our kids how to deal with money. This is just not something that
Good
is
point.
brought out to people many times because people aren't comfortable or understanding or knowledgeable. So we're here to help you educate, teach, and learn more. Reach out to us. Go to bnwealth.com. Call our office at 847-780-2980, and we'd be glad to help you. Also, if you're somebody out there who's looking for a financial advisor that has the same values as you, please give us a call. We'd love to see if we could help you. Again, 847-780-2980 or bnwealth.com. All right, we're out of time. Have a great week.
God bless.